Welcome to Quick Course Digest. Today, we're jumping into financial accounting, and I want you to just set aside any idea that this is all about boring, complicated math. It's not. Think of it as learning a new language, a very powerful one, the language of business. You know, every single company out there, from your local coffee shop to the biggest tech firms in the world, is telling a story. It's a story about how they're doing, what their health looks like, and where they're headed. Financial accounting is simply the language they use to tell that story. And once you learn it, you can understand what any business is really trying to say. So, ready to get fluent? Let's dive in. Every language has rules, right? A grammar that holds it all together. Well, in the language of business, the most basic, most fundamental rule of grammar is the accounting equation. If you can get this down, you've basically mastered the sentence structure for every financial story you'll ever read. And here it is. Assets equals liabilities plus owner's equity. It looks simple, but wow, it's everything. It just means that everything a company owns, that's its assets, has to be equal to all the claims against those things. And those claims come from two places. What it owes to outsiders, like banks, that's liabilities, and what the owners themselves have put in, that's their equity. This equation has to balance, always. It's like the law of gravity for finance. Okay, so we've got the grammar. Now, let's build up our vocabulary. And the very first word we need to nail down is assets. These are basically all the valuable things a company has that it can use to make money in the future. Now, not all assets are the same. We split them into two big groups. On one side, you've got your short-term assets. Think of these as the fast-moving stuff, like cash in the bank or inventory you're going to sell pretty soon. They're expected to be used up or turned into cash within a year. On the other side, you have the long-term assets. These are the heavy hitters, the buildings, the machinery, the delivery trucks. They're the foundation of the company, sticking around for years and years, helping the business tell its story. But here's the thing about those long-term assets. They don't last forever, right? That delivery truck gets wear and tear, that big machine gets older. They're being used up. And the way we account for that process is called depreciation. It's just a way of spreading out the cost of that big purchase over its useful life. It's how we write a little chapter in that asset's life story, year after year. So how do we actually figure this out? Well, the easiest and most popular way is called the straight line method. It's a super logical three-step deal. First, you start with what the asset cost you. Second, you take away what you think it'll be worth at the very end of its life. That's its residual value. And third, you just divide that number by how many years you plan on using it. That's it. Nice and simple. Let's make this totally real. Let's look at our company, Legacy Clothing. They bought a piece of equipment for $200,000. They figure they'll use it for 10 years, and at the end, it'll probably be worth about 10 grand. So you take the 200,000, subtract that 10,000 residual value, which leaves you with 190,000. Divide that by 10 years, and you get $19,000. That's the amount Legacy Clothing expenses for that machine every single year. Okay, so we've spent a lot of time on what a company owns. But remember our equation? That's only one side of the coin. We've got to look at the other side of the story. What does the company owe? And that brings us to liabilities, the company's debts and obligations. We'll also quickly touch on the opposite of that, receivables, which is money that's owed to the company. This is the world of financial promises, a two-way street of who owes who. So what do liabilities look like? Well, there's accounts payable. That's money Legacy Clothing owes to its suppliers for fabric and things. There are notes payable, which are more formal loans. But my favorite is unearned revenue. This is wild. It's when a customer pays you before you've even given them the product or service. You've got their cash, which is great, but you also have a debt, a liability to deliver on your promise. Now, what about the money owed to the company? That's called accounts receivable. It's when you sell something on credit, trusting your customer will pay you later. But, and this is just business, some of them won't. It's an unfortunate reality. So companies have to be realistic and estimate how much they probably won't collect. And they record that as a bad debts expense. It's a pragmatic, real-world part of the story. All right, we've got the grammar down, we've learned some key vocabulary words. It's time to put it all together and actually read the story. And the main chapters of this story are what we call the financial statements. Check this out. This is a simplified balance sheet for Legacy Clothing, and it shows our equation in action perfectly. Look at the left side. Total assets are $580,000. Now look at the right. Total liabilities of $375,000 plus owner's equity of $205,000. What does that add up to? $580,000. It balances to the penny. And you can even see our equipment listed net of depreciation. Beautiful. So the balance sheet is chapter 1. It's a snapshot of one moment in time. But there are two other main chapters. The income statement tells the story of how profitable the company was over a whole year, and the statement of cash flows gives you the play-by-play of how cash moved in and out. You need all three to get the full story. So you can read the story, that's awesome. But the next level is to become a critic, to analyze it, to ask the tough questions, and to figure out what's really going on between the lines. This is where the fun starts. And we have two really powerful tools for this. Horizontal analysis is like looking at a timeline. You compare this year to last year and see the percentage change. Did our sales grow by 10%? That's great. Vertical analysis is different. It's like taking a snapshot and seeing how all the pieces fit together right now. What percentage of our assets is cash? Both methods give you amazing insights. A fantastic tool for this kind of critique is a financial ratio. And one of the most common ones is the current ratio. It's a really simple calculation. You just take your current assets and divide by your current liabilities. It's a quick financial health checkup that tells you, can this company pay its bills that are due soon? And for Legacy Clothing, here's the result. Their current ratio is 3.74. What does that mean? It means for every $1 of bills they have to pay in the near future, they have $3.74 in quick assets ready to cover it. That is a very strong, healthy position to be in. It tells a story of stability that you just can't see from the raw numbers alone. So we've read the story, we've critiqued it, but there's one last really important question we have to ask. Can we even trust this story? Is it fact or is it fiction? This is all about tracking the actual cash and making sure the systems are reliable. This is why the statement of cash flows is so critical. Profit can be a matter of opinion, but cash is a fact. This statement cuts through all the noise and shows you exactly where the money came from and where it went. It breaks it down into 3 simple acts: cash from your main business operations, cash from big investments, and cash from financing, like loans. And how do we know the whole story is reliable? We trust it because of something called internal controls. Think of this as the company's internal fact-checking department. It's all the policies and procedures, like making sure the person who handles the cash isn't the same person who records the cash, that keep the story honest and accurate. So let's just take a quick look back at the journey we took. We started with the basic grammar, that all-important accounting equation. Then we learned how to read the chapters of the story, the financial statements. And finally, we stepped up and became the critic, learning how to analyze that story to find the true meaning. You now have the keys. You can decode the language that every single business speaks. So I'll leave you with this one thought. Now that you can finally read the story, what are you going to discover?